Hey all, and welcome to another video. It's a little on the late side here, so I'm going to keep it down a bit. It's 10 to 11 on Saturday night here, Central European time. I just wanted to pop in and share something that I've noticed in my trading this week, and maybe it can help you in yours too. And if I do carry on this sort of discussion on a Saturday, I'm gonna nickname it Psych Saturday or Psychological Saturday, because this is a time for reflection. At least it is for me, when the market's closed and I can have a think about what I'm doing and where I want to go next week. So what I noticed, I've got the 6J up in front of me. This is Friday's action, Friday the 24th of February, yesterday. And this was the trade which I reviewed in a video yesterday anyway, but I wanted to point out something that I noticed. So I entered here at 79, and I had a target at 70.5, which is an 8.5 tick stop target, sorry, for a 5 tick stop. So that's a 1.7R reward to risk. 1.7R in terms of 1.7R, we'll call it, reward to risk ratio. Now, without getting into the math part, because that would be more suited for a statistical Sunday, it goes without saying that if you cut down the reward, you skew the metrics of the system, and you potentially reduce or even completely ruin completely ruin an edge. You either completely ruin an edge, like shave off, reduce an edge, or even turn it into a losing edge by lowering the reward you get on your wins and keeping the risk side of things constant. So we want to make sure we're getting good enough rewards. That much is clear. So what happens when you get in here short and you have a target, and assuming your target's based on support and resistance, you are going to have a slowdown and potential reversal at your support and resistance before a continuation, which is what happened here. So the way I see it, you have two choices. You have your target out there and you wait for the target. If you see a slowdown before your target, you have two choices. Wait for the target, in which case it may reverse and even take out your stop, or you can get out right there for less of a reward. Now, assuming the reward is sufficient enough for your hit rate to still be profitable, why would we not do that? Why do so many traders, me included, insist on holding and then allowing a winner to so often turn into a loser? That is affected by the two polar forces of fear and greed. Fear and greed. They're both two sides of the same coin, because ultimately greed is a type of fear. Greed is the fear of a lack of abundance. So when you have that trade here, what are we thinking? Let's dig into our heads, using this trade as an example. You get reversal signals. It comes before your 1.7R target. You know it's enough to make a profit over time, but what are you thinking? You're thinking, I need more. You're fearful that you don't have enough. You want to make sure you get the biggest reward possible, so that would come under greed. So you hold. You hold, it gets near to your target, bounces away, and is coming back in your face. Now what are you feeling? You're feeling fearful. You're feeling fear that it's going to come back and you're going to lose all your gains. And I'll link to this video in the description box, as well as the book. But there's a video out on YouTube that talks about the the cognitive bias loss aversion, and this is also spoken about in The Way of the Turtle, written by Curtis Faith. And essentially it goes like this. We feel we feel actual losses, and by actual I mean losses of things that we already own, twice as much as we feel the loss of opportunity of an equivalent value. So let's use that, if that's a bit of a esoteric, if that's the right word, example. So let's make it more concrete. $100. Which one would you rather? Which one would you feel more pain for? Losing $100 out of your wallet, or missing the opportunity to gain $100? Most people will answer this one, losing 100 out of your wallet. When mathematically speaking, there's absolutely no difference between losing 100 out of your wallet or foregoing the opportunity of gaining $100, because both of them represent a net $100 negative deficit in your bank account, right? One you lose from what you've already got, and one you lose from what you could have had in an alternate universe where you opted to take the $100. So all of this, what this means is we go out of our way. We're twice as likely to avoid an actual loss of things that we quote own than we are to go out of our way to pursue gains of an equivalent value. So bringing this back to this trade, we've got paper profits and we own those paper profits, and we tend to think of those paper profits as being more valuable than twice as valuable as what we could get in the future in terms of a potential opportunity. So to cut a long story short, what I believe we should be doing is getting out before momentum turns. Because if you get out after momentum turns, you've gone to the side of fear about losing what you've already got, and you're twice as likely to mess up the trade and exit for a very poor, you'll try and hold on, and then ultimately many people exited up here before it made its move down, and they scratched the trade, or they made too small of a reward for their risk for it to work out in the long run with their hit rate and their trading metrics. So you've got to decisively exit for less and allow the market to go on. Get out before the momentum changes, because it's much easier to conquer the greed of wanting more than it is to hold on through the fear of giving back your gains. So that's my stance. It's not very eloquently put because I just had this idea down in the kitchen. But essentially what I'm trying to drive home in this video is there's the old market adage, bulls take the stairs, they walk up the stairs like that, and bears, they either jump out the window or they take the elevator. So don't wait for the bears to take over and the momentum to shift and get out on a stock market order and have slippage, because slippage is going to be when the market's moving against you, obviously, further reducing your reward to risk ratio. Get out before the turn and deal with the feeling of missing out. Deal with the emotion of greed on the way up, rather than deal with the emotion of fear on the way down. So that's all I got for you today. Like this video if you found it at all useful. Subscribe if you haven't already to tag along for this journey. And remember to follow your rules, stick to your plan. And I shall see you all probably tomorrow with a Statistics Sunday, but if not, I'll definitely, almost certainly see you on Monday. So have a nice rest of the weekend and see you then.